Hello there, this is the Gen Z Analyst. Welcome to my channel. In this video, we are coming to continue our discussion on investment banking and private equity. And we are going to start the complete course from this particular video. So in this particular video, what we're going to do is to continue our discussion on leveraged buyouts or LBOs. All right, so that's what we're going to do. Now, in my previous video, we looked at some of the number crunching when it comes to leveraged buyout model, and we looked at a high level introduction to leveraged buyout modeling. In this video, what we're going to do is to take a step back and look at some of the fundamental issues when it comes to leveraged buyout modeling or leveraged buyouts simply. So in this video, we are going to look at four main things. We'll be looking at some of the key participants when it comes to leveraged buyout or LBO transactions. We'll look at some of the characteristics of strong LBO candidates. We'll look at return analysis, some of the intricacies when it comes to return analysis, or how LBOs and participants calculate their returns on investments. And we'll also look at how LBOs actually generate returns. All right, so that's what you're going to do in this particular video. So let's get started. So you're going to look at the key participants in an LBO transaction. So who are the key participants? So the first participant you're going to look at is financial sponsors. So financial sponsor is simply referring to, we are talking about private equity firms, we are looking at hedge funds, we are looking at venture capital funds, special purpose vehicles, of that sort. We are looking at merchant banking divisions of investment banks. So all of these firms or individuals or companies are what we are referring to collectively as financial sponsors, and they are the major key participants when it comes to LBO transactions. All right, so what these individual or companies usually do is to raise funds from third-party investors and sponsor partners, as well as investment professionals, and organize these funds into structured funds or special what you call special purpose vehicles that they use to invest in another participant we will look at, which are targets. All right, so we look at these targets, collect funds from third-party investors, and use them to invest in them. All right, so what they do is that they also organize these funds into what you call limited partnerships. Okay, so they themselves will become the general partner, and these individuals, which are third parties, become what limited partners. So that's what they do. And some of these third party investors include, but they are not limited to, pension funds, both public and corporate pension funds. You are looking at insurance companies, you are looking at endowments and foundations. We are also looking at sovereign wealth funds and wealthy individuals, high net worth individuals and families. All right, so these are some of the individuals that sponsors source their funds from and organize these funds for investment into LBO candidates. All right, so those are the first participants when it comes to LBO. The second participant is what we call investment banks. All right, so investment banks also play a key role when it comes to leverage buyout. So what they do is that they perform thorough due diligence on LBO targets. So they do this usually alongside the financial sponsors. And what they do is that they go through an extensive internal credit process in order to validate the target's business plan and perform underwriting services. Okay, so they also underwrite a debt finance for the target. They are also relied upon heavily by sponsors to help develop and market an optimal financing structure. They may also engage investment banks as buy-side M&A advisors in return for sourcing deals and all for their expertise, relationships, and in-house resources. Okay, they also engage in sell-side transactions M&A transactions, and all of that. So they are key participants when it comes to LBO transactions as well. All right. The third one is commercial banks and institutional lenders. Now, because LBO is talking about investing in companies with high levels of debt, we cannot but involve commercial banks and institutional lenders who are typical lenders when it comes to the debt market. All right. So that is what we are also talking about there. And then we are also talking about bond investors. So again, we cannot talk about debt when it comes to uh, the debt market without talking about bonds. So we know that bonds are typical examples of debt that can be taken upon for investment purposes. Okay, so that is what we have there. Then we also have management. So management of both the target and sponsors also play a key role when it comes to identifying LBO targets and all that. All right, so those are the key participants in an LBO transaction. Now let's look at some of the characteristics of a strong LBO candidate. Now, what typically happens is that financial sponsors, as a group, are highly flexible investors that seek attractive investment opportunities across a broad range of sectors. All right, so during due diligence, what they do is that they do a due diligence. Then, during this due diligence process, the sponsor studies and evaluates an LBO candidate's key strengths and risks. Now, often, LBO candidates are identified among non-core or underperforming divisions of larger companies, neglected or troubled companies with turnaround potential, sponsor-owned businesses that have been held for an extended period, or companies in a fragmented market as platforms for roll-up strategy. So these are some of the things that financial sponsors do when it comes to identifying LBO candidates. And so there are certain characteristics that these LBO candidates must have to attract financial sponsors. And here are a few of them. The first one is that the candidates should typically have a strong cash flow potential. So this is really important because the financial sponsor is using a high amount of debt to finance the purchase price of the target. So when the target is able to generate strong cash flows, these cash flows are going to be used to finance or to repay the debt that is going to be used to finance its purchase. All right, so the ability to generate strong cash flows is really essential when it comes to the characteristics of a strong LBO candidate. The second one is a high asset base. Now, of course, this is directly related to the strong cash flow potential because a target with a high asset base can be able to generate high cash flows. All right, so that is that. Then we also look at low capex requirements. Again, this is also highly correlated with high asset base characteristics. So if the company has high level of assets base, then there will be no need for us to invest so much in capex. Okay, so that is that. And not being able to invest in capex means that we'll be channeling our money to repaying the high amount of debt that we have taken upon. All right, so that is that. Then we also have high growth opportunities. So a typical LBO candidate should have high growth opportunities. All right, so that will enable the sponsor to be able to generate enough cash flows to be able to finance the debt that has been taken. And then we also have relatively high market share. So an LBO candidate should be able to have a very high market share in the area in which it finds itself. This will attract sponsors to be able to invest in that particular target and generate the cash flow that is needed. All right, and then lastly, we want to look at proven management team. So the target should have a management team that is able to effectively manage the affairs of the target to be able to what generate enough returns on investment, or this management should be able to what reshuffle or restructure to be able to what to be effective enough to be able to generate enough cash flows for the um, the sponsor. All right, so that is that for the characteristics. Now these characteristics are not carved in stone. It may vary from sponsor to sponsor, but typically these are what sponsors generally look at when it comes to identifying a strong LBO candidate. All right, now let's look at returns analysis. So usually sponsors usually um, analyze their returns in two ways. So the first one is the internal rate of return. So the internal rate of return is the primary metric by which sponsors gauge the attractiveness of a potential LBO as well as the performance of their existing investments. So IRR measures the total return on a sponsor's equity investment, including any additional equity contributions made or dividends received during the investment horizon, which is typically 5 years to 7 years. So the IRR approach factors in the time value of money for a given amount of cash proceeds at exit. A shorter exit timeline produces a higher IRR for the sponsor, it, whilst a shorter investment horizon also means that IRR will decrease. Okay, now what is internal rate of return? Is defined as the discount rate that must be applied to the sponsor's cash outflows and inflows during the investment horizon in order to produce a net present value or NPV of 0. Okay, now although the IRR calculation can be performed with a financial calculator or using the IRR function in Excel, it is important to understand the math behind the calculations. All right, so you're going to be looking at that in Excel in a jiffy. All right, and then the second one that sponsors use to gauge their investment or return on investment is what you call the cash return. Now, this is also called multiple on invested capital, MOIC. All right, so that is what sponsors also look for when it comes to assessing the potential of a strong LBO candidate. And unlike the IRR, the cash return does not take into account um, um, the time value of money. All right, so we are going to look at examples in Excel to understand exactly what we mean by that. All right, so that is that about the return analysis. Now we are going to look at how returns are generated in an LBO in Excel. So let's head into Excel and look at how returns are generated and how we can perform return analysis. All right, so here we are in Excel. Okay, so when it comes to how returns are generated in an LBO transaction, sponsors typically generate returns through a combination of debt repayment and growth in enterprise value. So there are two ways LBOs generate returns: through debt repayment, that is repayment of the debt that was used in investing in the target, or growth in enterprise value. All right, so those are the two ways that LBO candidates usually generate returns. Now, we have two scenarios here to illustrate each of the situations that we have. So, the first scenario is dealing with debt repayment situation, whilst the second scenario deals with growth in EV or the enterprise value. Now let's make some assumptions here. All right, so now in the first scenario, what we are saying is that the target price of the target is actually the price of the target is actually 5 million. Okay, so these are in millions of US dollars. So this is 5 billion dollars. All right, so that is the price of the target. Now we want to finance this with equity contribution of 1.5 billion, whilst debt is going to be the difference, which is going to be 3.5 billion. All right, so that's the assumption we are making here. And then these investments is going to have a horizon of up to 5 years. All right, so we're going to be holding this investment for a period of 5 years. Now remember, the target price is 5 billion, equity contribution is going to be 1.5 billion, and our debt is going to be what? Equal to 3.5 billion, which is the difference between the target price and the equity contribution. All right, now we are also saying that we are going to be repaying the debt of up to 3 billion over the 5-year period. So cumulatively, we're going to be paying $3 billion. All right, and then at exit, we are going to sell the target at $5 billion. So these are the assumptions we are making. Now follow me very critically. Now we are going to, let's look at the equity value at exit. Equity value at exit. Now, the initial equity contribution is 1.5 billion, and we are going to be decreasing the 3.5 billion. So this is actually how we got the 3.5. That is going to be this minus the equity value of 1.5. So this is 3.5. All right, so that is the debt amount. Now we are seeing that at the end of the 5th year, we want to reduce this debt amount by 3 billion. All right, so that is the decrease in debt you are seeing here, 3 billion. And so this 3 billion is essentially equity now, because the debt has been reduced by this 3 billion, and this 3 billion will be added to our equity. And so now at the end of the period, our equity will rise from the 1.5 billion to 4.5 billion as a result of the addition of the debt we have repaid. All right, so that is how we analyze these. Now when you look at this, we have IRR and the cash return. Now the IRR is saying that we use the IRR formula, as you can see here. Now that is calculated based on these cash flow projections here. So we are seeing that initially we invested 1.5 billion, and at the end of the period we had an exit value of 4.5 billion. Now when you calculate the IRR as we have here, you have 24.6 billion. Now, as we have already demonstrated in our previous video, sponsors typically require a minimum of 20% IRR. So in this particular situation, the target is a strong LBO candidate because it's generating an IRR of 24.6%, which is generally acceptable. Then we also have the cash return. The cash return is calculated by dividing the equity value at exit by the equity value at the beginning of the investment period. Right, so that is how we calculate the cash return. So this is the first scenario. Okay, the first scenario is debt repayment. So when you repay our debt, the amount by which we repaid our debt is going to increase our equity position. Okay, now it means that effectively at the end of the 5th period, equity has risen to 4.5, whilst our debt has reduced to only $500 million. All right, so that is how we analyze this. So that's the first scenario here. The second scenario is growth in enterprise value. So what you're saying is that the same assumptions is going to apply here. The target purchase price is $5 billion. Then we are going to make an equity contribution of 1.5. This means that our debt position is going to be 3.5 billion. All right, now in this particular situation, instead of debt repayment, repaying our debt, what you are saying is that we are rather increasing the enterprise value of the target. So the initial enterprise value is 5 billion. Now we have increased the enterprise value to 8 billion at the end of the 5th year. Okay, but instead of using the amount to repay our debt, we are rather using it to increase the enterprise value. So that is what we are seeing here as the 8 billion here. All right, so let's come to the equity value at exit. So here, you're going to be having equity contribution of 1.5 billion, as we are seeing here. Then we have increased our enterprise value by 3 billion. That is calculated by the difference in the exit sale price here minus the initial purchase price of 3 billion there. All right, so when we add those two figures together, this is giving us an equity value at exit of 4.5 billion, as we have under the debt repayment scenario. All right, and as you can see, the return analysis is giving us the same figures here. Okay, so that is how this works. Now, no matter what the scenario is, the return is the same because the assumptions are what? The same. All right, so as you can see, the IRR will be calculated using the same format here because the equity value has increased from 1.5 to 4.5 at the end of the 5th year. So that is how we deal with these situations. All right, so that is how we are going to end our video for today. Now, in our next video, we are going to be looking at how sponsors use leverage or gearing, depending on where you are coming from, to enhance their returns. In other words, we want to look at why sponsors use a significant amount of debt instead of equity to finance the target. All right, so as you can see in this scenario, if we look at the percentage of equity in relation to the percentage of debt, you could see that this is what 30%, which means that the debt is up to 70%. So let's do that and see. So this is 3.5 billion divided by 5 billion. So that is what 70% amount of debt. So in our next video, we want to look at why debt. Okay, why this amount of debt to finance the targets. So that's what we're going to be looking at in our next video. All right. So, and then we are going to illustrate this using a number of scenarios for clarity and practical understanding. So make sure you have glued to this particular channel by subscribing to the channel, okay, and turning on the notification button for updates. All right. And also don't forget to like the video if you found the content useful, and don't forget to share with others so they can also benefit. All right. So until then, I will see you in my next video.